Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended January 25th, 2017. And primarily we'll be talking about the conventional fund business at first, but certainly we'll dab into the ETF world as well. Conventional fund business saw about $16 billion flow into their coffers this week. And those numbers might be a little bit deceptive because we've been seeing, a long rally in equities since the presidential election, and then also we actually saw the Dow finally break through and then close above the 20,000 mark on Wednesday. So people might think that that was an equity exposure. You're going to find out that's not the case. Actually, we had some really good news out there when we're taking a look at the weekly jobless claims. They actually declined. The new weekly jobless claims declined more than expected, and that kind of surprised investors. And then also we saw that we had better than expected earnings. Our folks at the proprietary research team here at Thomson Reuters actually came out and said, I think it was 74% of all those that had reported Q4 earnings thus far had beat earnings expectations. So that's actually a really good number. However, everybody knows that Donald Trump was inaugurated as a president during the week, and I think a lot of people sat back to see what his policies and what his procedures really are going to be. And so let's see how that panned out and see how people took a defensive stance this week by looking at our macro groups. We saw that equity funds lost about $4.4 billion, as I was saying, and this is where we saw the outflows. Taxable bond funds saw some inflows, only to the tune of about $500 million. Muni bond funds saw about $200 million in net new money coming into their group. And then money market funds was the big collector of assets. This is on a safety move, but really when we're talking about year-end and bonuses and all the rest of the stuff, maybe people are just parking into the money market funds right now. So we saw about $19.8 billion in new money coming into their coffers as well. So that was the big kind of story of the week. Let's take a look how it panned out for equity funds, and we'll take an individual focus on that. Despite having a 1.58% return for the week, we basically, in the third week and four, by the way, that we've seen positive returns, we saw about $4.4 billion flow out of the coffers. And again, this is a fourth consecutive week that we've seen outflows from equity funds. This is retail only. This is not ETFs. We'll talk about that in just a moment. But if we break it down even further, we saw that domestic equity funds basically saw about $4.2 billion in outflow, and it's the fourth consecutive week that they also seen the outflows as well. They had a return of 1.42%, so it was on the plus side. If we take a look on the non-domestic side, we saw about $200 million of outflows. Not a big story here. First week in three that we've seen outflows, and they had a return of 1.93%. So really, that's kind of where the story is. It's a little confusing that we're not seeing more out of the non-domestic equity funds. Investors are either seeing good buying opportunities, or maybe they were lifted up by the report that China had a better Q4 GDP growth than had been anticipated, and some other news that is out there as well. So perhaps that's going through to not seeing huge outflows out of the non-domestic side. How it breaks out, though, we take a look at large cap funds. They were the big pariah of the group. So you've seen about $3.4 billion. And again, getting away from international, looking at global funds on the world equity side, we saw small outflows, about $400 million outflows from that group. Well, let's take a look now at ETFs to see what happened. And a lot of tale of two cities have been talked about over the last several months. This is not the case. We saw that the ETF investor authorized participants also took money out. Second consecutive week, they've had net outflows, $1.3 billion for this week. And at the top of the group, as far as taking money in, we saw the iShares Core MSCI EFA taking about $948 million. And then we saw the Tech Select Sector Spider Fund take in about $897 million. At the bottom of the story here, we saw PowerShares QQQ Trust One basically lose about $2.1 billion. And then we saw Spider S&P 500 actually lose about $2 billion on its own. So really, the story was investors were getting conservative, not only retail investors, but also the authorized participant ETF investors, those institutional investors that are allowed to create and destroy shares, were really in lockstep together this week. Let's take a look how that's panned out, though, for the fixed income community, because we actually saw net inflows into that group, fourth consecutive week that we've seen net inflows, this time only to the tune of about $500 million. And again, it's the fifth week in six that we've seen plus side returns, 0.18%. So investors, even though there's been a pretty good equity market, kind of some ups and downs going on, but pretty strong going on, we have seen investors actually take a turn and go back to the safe haven plays. Now, They're not going totally safe haven, at least not on the retail side. We saw corporate investment grade debt funds taking about $971 million. That's the 8th consecutive week they've seen inflows. And I think I've told you before, loan participation funds, for some reason, in the proprietary, or I'm sorry, into the legacy product that we used to go to, they put loan participation funds into the corporate investment grade group. And so what made up most of those flows is $778 million into loan par funds. So people are certainly betting that the Fed is going to raise interest rates once again. At the bottom of the group, we saw corporate high yield funds lose about $365 million. So again, this is back to that concept that people were taking risk off their portfolios. Now let's turn our attention towards the ETF side of the fixed income universe. Actually, they've seen inflows for the 4th week in 5. We saw about $2.4 billion in net inflows this week going to the coffers. At the top of the group, we saw the iShares U.S. Treasury Bond Fund, safety play again here, $734 million in inflows. We saw the iShares mortgage-backed securities, MBS, ETF, taking in about $583. And at the very bottom of the barrel, we saw iShares JPN U.S. Dollar Emerging Market Bond Fund lose about $256. So we really were seeing, again, a safe haven play and more towards the ETF side, authorized participants really padding the coffers of treasuries. Well, let's take a look now at our muni bond fund group. And there we saw for the 3rd consecutive week inflows, finally, $154 million this week. It's the 1st week in 5, though, that we've had negative returns, 0.56% loss as far as returns for the week goes. And obviously the big attractor of assets, as it has been for many weeks now. National Munis saw about $147 million in net new money coming to their group. 3rd consecutive week, they've taken in net new money. Well, that brings us now to the money market group. And again, I told you the money market funds saw some big inflows, $19.8 billion, 1st week in 4 that they've actually taken in that new money. And how it broke out is taxable money market funds saw about $20.1 billion of net new money coming to their group, while tax-exempt money market funds saw about $270 million in outflows. But if we take a look at the taxable money market side, we can see this was mainly an institutional move. We saw about $20.1 billion of money come into the $25.3 billion come into the institutional group, and we saw about $5.2 billion leave the money markets on the retail side. So money market funds, again, turned out to be more institutional. We could actually add that up to be, funding going into people's IRAs, 401ks, year-end funding, that kind of stuff. So that might be part of the story. Well, that's it for me this week, but we saw news come out this morning. Basically, we saw a decline in durable goods orders for December. A little bit of disappointing news, but I think investors really are done with the Fed. They're obviously looking at economic reports because we all need to, but really I think the story this week and over the next couple of weeks is going to be earnings reports. And as I said before, we've seen pretty good earnings reports so far, and I think what people are going to be looking at is the kind of forecasts that companies are going to put out there. Are they comfortable saying that, with the new administration in office, will they actually come out and say they think the 1st quarter earnings are going to be good? Well, we'll keep an eye on that. Well, if you want to do a deeper dive, go into areas that I have not taken a look at, you can go to www.lipperusfundflows.com or join us next week when one of our analysts will talk about the flows of the week. All right, well, thanks for joining me. My name's Tom Roseen, and I'm wishing you the best in your wealth planning and creation.